Are markets efficient? Academics and practitioners seldom agree on this. Academics would like to believe that there's a simple unifying theory of finance that says that markets in the long run will be efficient, that it's impossible to have abnormal returns, and yet practitioners are constantly looking for that abnormal return. They want to be able to tell their clients they can consistently outperform the average for the market. In today's session, we're going to take a look at whether or not there are such things as efficient markets. We'll look at an academic theory of market efficiency, the different forms of efficiency from the most restrictive to the loosest form of efficiency. And we'll take a look at the experience. Have practitioners actually been able to consistently beat the markets? This is also connected to a couple of other major topics we'll look at later. We'll start to talk about behavioral finance, and we'll also take a look at anomalies, bubbles, and crashes in the videos that will follow. The idea of market efficiency stems from the idea that individuals can be dumb, but collectively, people are smart. In other words, individuals may make a wrong guess, a little bit high, a little bit low, but on average their errors are unbiased. So when we take the sum of all of the answers from a group, the collective answer, the average answer, will be close to correct. In fact, this idea goes back a long way. It goes back to the foundations of statistics. One of the early statisticians, Francis Galton, in the early 1900s, did a practical experiment with a group of about 800 villagers. He asked them to guess the weight of an ox at the county fair. Well, individually, everybody was wrong. Nobody got the right answer. Nobody guessed the exact weight. But when Sir Francis took the average of all of the answers that he received, he found that the answer was very close to the ox's actual weight. So from this we get the idea that there is a wisdom of crowds. And that's the kind of thing that markets are meant to portray. This kind of a wisdom suggests that somebody cannot consistently outperform or beat the market. In fact, there's a great example from a book by Burton Malkiel. And this example probably goes back an awful lot further than that, that says that essentially all the best fund managers, when they put together their skills and the time and the expense that they've taken to analyze the market, cannot consistently beat a monkey throwing darts at the stock pages in the newspaper. You may have heard that story. I believe it goes back even further than Burton Malkiel, but he's given credit for it because of the very important book that he wrote, A Random Walk Down Wall Street. So probably not possible to beat the markets. This led to research by academics, probably the best known of whom was Eugene Fama. He proposed, and he provided a lot of support for a hypothesis that says that as a practical measure, all major financial markets reflect all relevant information at a given time. So because we've got so many different sources of information, both the official ones and the unofficial sources of information, whatever a stock's price should reflect the true value of that company. And that it's hard to have private information that does not remain uncovered. Essentially, this research takes a look at the relationship between stock prices and available information. This was not entirely new information or a new theory at the time. It also goes back to work that was done earlier by people like Bechellier, Mandelbrot, and Paul Samuelson. But Eugene Fama is most famous for this, something that he earned the Nobel Prize for. You can actually see that there was a Nobel Prize presentation in 2013 when Fama actually shared the Nobel Prize with Robert Shiller. Now, interestingly, as this article points out, Shiller and Fama actually said opposite things. Fama said markets are efficient. It's impossible to beat the market, where Shiller was probably better known for his belief that you can predict market mispricing when we see that the price earnings multiples are too high for the market. And he says that over the past century, it was possible to time the market. by taking a look at things like his price earnings multiple model. Today we'll take a look at some of the story behind that. In fact, we'll start off by going back to the basic question. Is it possible? Or what do we mean when we say we beat the market? Essentially, beating the market says we have to be able to make a return in excess of a fair rate of return. And a fair rate of return is often characterized as the rate of return you would get by putting your money into a portfolio of all of the stocks that are available to purchase. That creates a kind of an abnormal return, and beating the market means consistently earning a return above normal. Now, essentially, efficient market hypothesis says that market efficiency exists for any one of these three reasons. First off, investors use information in a rational manner. They systematically overvalue or undervalue financial assets. That every investor will always make perfectly rational decisions. Now, of course, we know that people don't always make rational decisions, but that's partly covered by one of the next points. Secondly, that there are independent deviations from rationality. If many investors are indeed irrational, and a company provides new information, some investors will be overly optimistic, some investors will be overly pessimistic, and that these will cancel out. The net effect means that there is no irrationality. In other words, individuals can be wrong, but the collective will be right. The third point says that there will be people available to make markets work when irrationality exists. These people are arbitrageurs, not speculators, but investors whose purpose is to find mispricing in the market, will identify that mispricing, and they will buy to the point where the mispricing disappears. So that is the function of those arbitrageurs. They say that each of these three conditions is individually so powerful that if any one of them exists, we would expect to see market efficiency. Now, Fama's approach, or Fama in French, when they did their research, said that there were three different possible types of market efficiency. A weak form efficient market is one in which all past prices and volume information are of no use in beating the market. If that's the case, then measures or techniques that people use, like technical analysis, will never work. The second possibility is that market efficiency is only semi-strong, and that publicly available information is no use in beating the market. If that's the case, then markets will be perfectly priced, and there's no point in doing even the most standard of our fundamental analysis. A strong form efficient market is one in which any information, either public or private, is no use of beating the market. And if that's the case, then even inside information would be of little use. And to put that into a chart, essentially we see that the set of all information starts off with the weak form saying that information from past prices and volume is going to be available, and that will help us to predict the market. Semi-strong means publicly available information. The information that's provided through the Securities and Exchange Commission, for example, will provide all the information we need to predict the market. And the strong form basically says that investors have information to all information, public, private. There's no such thing anymore as insider information, at least not for any period of time. So essentially would say that a market would be efficient because of competition and the profit motive, when relatively small performance enhancements can be worth a tremendous amount of money. Keep in mind the value of margins and leverage, so even a small discrepancy, a fraction of a penny, through persistent trading, through leverage, the type of activities that hedge funds operate in, would drive out any abnormal return or surplus profit very quickly. That profit potential creates incentives to unearth all relevant information and to use it. And we've got massive funds. For example, Fidelity has about 15 billion funds under management as of 2019. And if they could improve their their performance by as little as 0.2% or 20 basis point, that means that they would be willing to spend up to, well, 20 basis points times $50 billion or $30 million to find that small bit of efficiency. And think of how many MBAs, quantitative specialists, that you could hire for that $30 million. And of course, we do know that there's a lot of money spent, but not nearly to that level of efficiency. Some implications. Well, researchers have used a variety of different types of sophisticated techniques to test whether past stock price performance could predict future price movements. And they have been able to show that future returns are partly predictable from past returns, but there's not enough predictability to create sufficient excess returns. And here we're only talking about hundreds or even thousandths of a percent, and to do that persistently. Trading costs. Trading to create enough profit in order to profit from that new information would probably wipe out any of those extra returns. So the suggestion from most efficient traders is that buy and hold strategies involving a well-diversified market portfolio or even a broad index are likely to be difficult to outperform. So for technical analysis, the implication is no matter how often a particular stock price path has related to subsequent stock price changes in the past, there's no assurance that pattern is ever going to occur again in the future. Now, pattern recognition, according to this, probably not going to work. Does that suggest that technical analysts have given up? Well, not at all, as we'll see in a couple of our later videos. This entire thesis that you can beat the market has been debunked and debunked and debunked over and over again, and yet people are still talking about beating the market. Probably one of the best known versions of this is a book by Burton Malkiel that's probably one of the best selling books in finance ever, called A Random Walk Down Wall Street. A bit of a pun in the title. By random walk, what do we mean? If stock prices truly are predictable, well, many people suggest that. Research has shown that prices change over time in a random manner. Stock price increases are just as likely as stock price decreases. And when there's no discernible pattern to the path that a stock price takes, we describe that as a random walk. In fact, you can see on this particular chart from the textbook that we're using for our slides for a lot of this session, that with the change in percentage marked around 0. In other words, 0 represents no change, 5% means a 5% change in that one day of trading, and minus 5% means a 5% decrease in that day of trading. When you take a look at the patterns for any particular stock, you can see that there is a lot of variation. There's perhaps new information or changes in the value of information that occurs during the day and from day to day that results in shocks up and down. However, we see that the overall effect seems to be mean reverting. In other words, the average value of 0 tends to be the one that we observe on average, if not every day. This is going to be affected by new price information that will be coming into the market on a day-to-day basis. Perhaps a new product is not doing as well as expected, or a new market is not doing as well as expected. We have got concerns about management, or perhaps concerns about the competition. And as that information comes into the market, the efficient market hypothesis deals with that according to the three different forms. In the semi-strong form, the efficient market hypothesis says that stock prices already include all information. New information should not matter. Stock prices change when traders buy and sell shares based on their view, but the future prospects for the stock can still be influenced by unexpected new announcements. There are three different ways that new information is incorporated into the market. In an efficient market, the price instantaneously adjusts to new information. We could have a delayed reaction where the price adjusts to the new information, but in a delayed fashion. And we can also have an overreaction and correction. In that case, the price adjusts to the new information and overadjusts, and then will eventually correct back to the expected level. If we're going to use the efficient market reaction, here we've got a price for a stock, say $67, and in the days before, the price has not adjusted because, well, we don't see any information leaking into the market. So 3 days, 6 days before, there was no indication that there was going to be an adjustment. Bang, there's a new announcement, there's some new information that comes in, and according to the efficient market, the price would go up by, in this case, to about $85, and then the price would stay. The efficient market incorporates all information, and that information, that signal that we receive, is instantly accommodated. In the delayed reaction, we get new information, but not everybody hears the information right away. It takes a little while for that that signal to actually be absorbed, and eventually it'll occur. That means that for perhaps 3, 4, 5 days beforehand, the stock will be underpriced, and then there'll be a buying opportunity, and as people get the information, they buy into it, and eventually we reach the fair value, the blue line. The other possibility is overreaction, and so we can see here that at the time of the price signal, the stock price goes up to 87, goes up even higher, more people get excited about it, they overreact, but eventually the overreaction dies off and we end up with the price reverting back to the efficient price. So, 3 different ways that the new information is going to be incorporated. We've studied this, academics have looked at this using a variety of different types of signaling events. Information about dividends or information about earnings, perhaps changes in management or changes in laws or accounting standards that will affect the value of a stock. And we describe this type of research as an event study. What happened around the event? The researchers have been adjusted in the signal, what is the actual information that's provided, the process of adjustment, the size of the stock reaction, and the timing of the stock reaction as well. That's what we mean by an event study. A particular example of this, we can take a look at a company called Advanced Medical Optics, Inc. And they had made an announcement that they were having a problem with one of their products, a contact lens solution that had been associated with, by the Center for Disease Control, of a particular type of fungal infection. They made an announcement, as companies are required to do, and around this announcement, we observed what would happen to the stock price. So in 2007, when they made this announcement, you could see that their share price on May 27th had been trading around, well, $43, $44, $45, and then at the time of the announcement, the price dropped to around 35 and continued to trade there in the next few days. So down about $6, $5.83 from the previous day. An instantaneous reaction to price signal information. To study a problem like this or an event like this, we'd have to be able to separate information that would affect the company itself from things that would affect everybody else. So other companies were having issues. There might have been a war starting in another country or something like that that could have also affected the market. So we need to figure out what the expected change in the market would be. And to do that, we calculate the abnormal return. The abnormal return in this case is the observed return, the price signal effect, $5.83, minus the expected return. And we get the expected return by taking a look at the daily return from a broader index like the Standard & Poor's Index or the NASDAQ 100, and compare that to the long range return, or compare that to the long range return on the stock. We then try to align the abnormal return on the stock to the days relative to the news announcement. So how would that have affected the previous days? And for this, we look at the cumulative abnormal returns. According to the efficient market hypothesis, An abnormal return today would only relate to the information released today. And then to evaluate the abnormal returns, we would compare them over a 60, perhaps an 80-day period. In the next slide, we'll see how there's a plot of the cumulative abnormal returns, the abnormal returns accumulated over the entire period, starting 40 days before the announcement and going 40 days into the future. In the first, this period, this point here is 0 days. So this is the time of the announcement, and we can see that there were basically no abnormal returns, or the returns were all expected returns in the period up to 40 days beforehand. And then at the time of the announcement, we see the significant drop, and we see a 15% decrease in the returns from the normal returns over that period. And perhaps a little bit of oscillation here, which is interesting as well. So basically the first cumulative abnormal return that we receive in here is just about equal to the abnormal returns 40 days into the future. There's really no significant price signaling information. So essentially, the pattern of cumulative abnormal returns here that we see is exactly what the efficient market hypothesis would predict. Now, what about inside traders and inside information, or informed traders, and how are they different from inside traders? We say that if a market is strong form efficient, no information of any kind, public or private, is useful in beating the market. Now, we suspect that's not entirely true because we have a lot of evidence of insiders, especially in markets which are not well regulated. It's clear that inside information can help you to earn substantial excess returns. So, should anybody be able to earn excess returns or extra returns based on information not known to the public? Here's where we want to make the distinction between informed traders and inside traders. In most well-developed markets, it's illegal to make profits on non-public information. We require this in order for investors to feel that there's a level playing field, that it's a good place to put your money into that particular market. So in the United States, the Securities and Exchange Commission maintains a building full of lawyers whose job it is to identify corrupt trading practices. But before we do this, we need to think about some of the legal definitions, in particular in the United States, where there's a distinction between informed trading, legal insider trading, and illegal insider trading. According to our textbook definitions, informed trading is when an investor makes a decision to buy or sell a stock based on publicly available information and analysis. An informed trader is someone who is informed by publicly available information, perhaps a bit of intuition and experience based on historical patterns, but you can get that information from sources that are public, like the Wall Street Journal, Bloomberg, taking a look at the company's publicly provided quarterly reports, gathering additional financial information from other sources, and listening to the pundits. Legal insider trading is also possible. When we think about insider trading, we always think that it's illegal, but it is actually legal for a company to make trades as an insider, provided that they comply with the reporting practices of their company and of the Securities and Exchange Commission. So if somebody's an insider, if they are somebody who is an officer of a company, or somebody who has information about research and development product of the company, it's still possible to trade in the company's stock, but you have to do it within certain boundaries, within certain limits that are prescribed. That means that these trades have to be reported and scrutinized, and if there's evidence that abnormal profits were earned, then we've drifted into the other category of illegal insider trading. In fact, you can see that there's been a very large discussion of the role of politicians in insider trading, with several congressmen, both Republican and Democrats, recently being charged or being investigated rather, for insider trading, and in most cases being sanctioned by either Congress itself and considered for prosecution outside the government in the judicial system. So clearly there is an awful lot of possibility of insider trading. We did have one very famous insider trading trial in the last couple of decades. Martha Stewart, famous television personality, famous for saying it's a good thing when she's talking about some of her recipes or design ideas. She was charged and she was convicted, not for insider trading. That was part of the process, though. The Securities and Exchange Commission believed that Martha Stewart was told by her friend, one of the principals of a company that she'd invested in, about a cancer drug that was being developed and that had been rejected by the Food and Drug Administration. That would be very bad news for the company's shares. Martha sold her shares, or some of her shares, immediately. And on the day that she sold the shares, the company traded below $60 a share. Martha Stewart said that a stop-loss order had been triggered and that it wasn't a decision based on information. The Securities and Exchange Commission believed that it was evidence of insider trading, and because she had that information from her friend, that it was something that she should be charged with. In the process of investigation, Martha Stewart was convicted, however, not of insider trading, but of obstruction of justice because of the way that she communicated some of the information to the Securities and Exchange Commission later on. So she was convicted of 4 counts of obstruction of justice. She was fined $30,000 and sentenced to 5 months in prison, 2 years of probation, and 5 more months of home confinement, the maximum that was allowed by American law, and a very public example of insider trading. Are markets really financially efficient? We've studied financial markets just about as much as can possibly be studied. Just about every finance professor has done some kind of research on market efficiency. We have colossal amounts of data that are stored about trading and available publicly through a variety of sources, especially in the last 20 years. And the data has been exhaustively studied and analyzed to see whether or not there is truly market efficiency. But there are a number of different reasons why we never get this quite right. One of them is that there's a risk adjustment problem where calculating abnormal returns may be difficult and difficult to measure. Having relevant information. The fact that some investors just seem to outperform because of probability or dumb luck. And something called the data snooping problem. We can generalize about, or make several generalizations about market efficiency. That stock price, short-term stock price, and market movement, or little evidence that such reactions can be profitably exploited. And if the stock market can be beaten, the way to do so is not obvious. So, some implications if markets are indeed efficient. Well, if this is true, your ability to pick particular stocks will become less important because securities should be or will be fairly priced. Professional money managers may have limited role in the production of efficient portfolios, and there's little probability or possibility of being able to time the market. Now, what about professional money managers? How well do they, or can they do? If you think about this as a kind of a contest where we rank professional money managers and give them ratings and pay them according to their performance, well, we'd have to say that there has to be some kind of an opportunity for them to significantly outperform. Otherwise, why are we paying them so much money to manage portfolios? They have skills, training, lots of computers, analysts, quantitative specialists to help them pick stocks. shouldn't they be able to outperform the market? Well, the simplest and the best measure that we've seen so far is that investors, average investors, who buy into broadly based, well-diversified portfolios, like in this case the Vanguard 500 Index Fund, a very broadly based portfolio, managed at very low cost by as an ETF or a mutual fund. Since they're already buying all of the stocks in the market, why don't we just put our money into a portfolio like that, and we should be able to outperform all of these professional money managers with their high salaries and their high overhead costs. We can see when we take a look at the actual performance over time from a chart like this one from our textbook. The blue line represents all of the funds that are professionally managed over this very long period. That is the totality of the funds. The dotted blue line represents the number of funds that beat the broad-based index, the Vanguard index, over that time. So somewhere in the area of 50% or less actually beat the average. Now, remember, we're talking about an average here. So normally we'd expect about half of the fund managers to do better and half of them to do worse. And the experience that we see here is exactly that fund managers on average are doing no better than the individual investor would be doing. Now there's another time series here as well. This one's a bit shorter because it's using a broader period of time, and it says how many funds were available over the last 10 years and how many funds beat the average over that period as well. In fact, we can see that fewer than 50% managed to beat the index over a very long period of time. And by long period of time, you can see from this other chart that the percentage that could beat the average in some periods, in some years like 2000 or 2005 it looks like, a significant number managed to beat the index, but in other years a very small number beat that index. So on average 50% actually looks like a pretty generous number. It doesn't look like on average the average fund manager could beat the market. And when we look at a longer period of time, we see that's even more so. A little bit more consistent, but more so. So in the years that we're looking at, over this very long time series, over 30 years from 1989 to 2018, in 12 of those 30 years, more than half beat the Vanguard index for a year. When we look at a 10-year period, 11 of 21 periods, the professional managers managed to win out. Now, in summary, market performance and the performance of professional money managers, even if we divide the time periods into rolling 3-year, 5-year, 10-year investment periods, what percent of the time did half of the professionally managed funds beat the index? What percentage of the time did 3/4 of them beat the index? And here are results, again from our textbook. When we're looking at the totality from 1989 to 2018, 30 investment periods, 12 out of 30 managed to beat the index, or about 40%. Looks like about the best period that we saw was from 1998 to 2018, 21 investment periods, 11 out of 21 managed to win out, which gives us a percentage just slightly better than the mean, 50%, 52%. And over this entire period, how many did 3/4 of the how many investment periods did 3/4 of the funds beat Vanguard? Well, 1 out of 28, 1 out of 26, and 3 out of 21. So in the best possible period, only about 14% could outperform. This information raises some potentially difficult and uncomfortable questions for analysts and investment professionals. If markets are inefficient and tools like fundamental analysis are valuable, why can't these fund managers beat a broad market index. The performance of money market managers is especially problematic when we consider the enormous resources at their disposal and the survivorship bias, the fact that we're not reporting about the funds that did not survive over this entire period. Now, if it were possible to beat the market, then the process of eliminations should lead to a situation in which survivors can beat the market, and that means that the performance is effectively over-reported in this case. So why do we need professional money managers? There is actually a good reason still to use money managers to manage your funds. To build a portfolio to meet the specific needs of individual investors, we need to be able to create a diversified portfolio which is suitable, optimal, for particular investors. Every investor has different characteristics with respect to things like age, tax bracket, risk aversion, and even correlation of other assets, perhaps because of employers. For example, if you work at Starbucks and part of your compensation is stock options. Like many companies, Starbucks offers its employees either stock options or an employee share ownership program that provides an opportunity to buy stock at less than market value. You could end up with a lot of Starbucks stock in your portfolio, which means your portfolio is not diversified. The role of your portfolio manager is clearly to point this out and to find other types of investment which will be not correlated and provide more diversification. So, in this session, we've had a look at the foundation and the forms of market efficiency. We've looked at some of the implications of market efficiency. Does historical information help predict future stock prices? We looked at the idea of a random walk and stock prices. We talked about how new information is brought into share prices and looked at how event studies have studied this in the past. We introduced the idea of informed, legal, and illegal insider trading. We talked a little bit about efficiency of markets and the actual performance of fund managers. And we talked a little bit about the remaining role for those professional fund managers. This is stage one. Now, what if markets really aren't efficient? We will take a look at some of the cases in which markets did not behave rationally, where we saw bubbles, market anomalies, and also crashes. And to do that, we'll move to our next video.